Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. While most central banks, including the US Fed, are still increasing interest rates to tame inflation, the Reserve Bank of India has lifted its foot off the pedal. Its Monetary Policy Committee has kept the policy rate unchanged at 6.5% after 6 consecutive hikes. The panel also lowered the projection for inflation in FY24 and moderately raised the growth outlook. Now the question is, has the pause come too soon? And how will the economy fare in the next 6 months? Bhaswar Kumar brings you the answer.
The MPC remains watchful and will not hesitate to take further action in its future meetings as may be necessary. So, the job is not yet finished.
With this statement, RBI Governor Shaktikanta Das left the door open for the MPC to hike rates in future meetings, even as it pressed the pause button after hiking the repo rate by 250 basis points since May 2022. In fact, Governor Das said that the decision to pause was for this meeting only. With the latest MPC meeting ending on April 6th, the policy rate stood unchanged at 6.5%. However, the rate hikes that kicked off in May last year were preceded by the introduction of a standing deposit facility at 40 basis points higher than the fixed rate reverse repo. Thus, the effective rate hike since April last year has been 290 basis points. The decision to press the pause button was taken unanimously by the rate-setting body. By a 5-to-1 majority, the MPC also decided to remain focused on the withdrawal of accommodation. This was done to ensure that inflation steadily moves towards matching the RBI's target. While support continues to be provided for growth, RBI's mandate is to keep inflation at 4% with a tolerance band of 2 to 6%. In his statement, the RBI governor said that the monetary policy actions taken since May 2022 were still working their way through the system. Hence, the MPC decided to keep the policy rate unchanged to assess the progress made so far. Das added that the MPC would not hesitate to take further action, if warranted, in its future meetings. The pause comes after 2 of the MPC's 6 members, Ashima Goyal and Jayant Verma, voted against the decision to increase the repo rate by 25 basis points in its February meet. In February, Goyal had said the RBI didn't need to continue raising rates until prices fell because there could be a risk of overshooting the inflation-adjusted real rate, which currently stood at an appropriate level for India at around 1%. The pause in repo rate hikes came as a surprise. While declining marginally from the January print, the retail inflation rate in February still remained above the RBI's upper tolerance limit of 6% for a second consecutive month. As a result, analysts had predicted another rate hike by 25 basis points in the April MPC meeting. So, what do experts think about the timing of the pause in rate hikes?
Given that the central bank has raised interest rates by 250 basis points, and this has been the fastest pace of rate hike in the decade, I would say, they thought it appropriate to assess the impact. And by the way, I think they have, it's not a full stop as yet on the rate cycle. It could be a comma as well. So they have kept all their options open by maintaining the stance.
I think it's a little late. I've been suggesting that the rate hike should have been paused about 50 basis points earlier. But, you know, a lot depends upon what kind of monetary policy you believe in. Mine may be somewhat different from theirs, but I think they've done it too late, but I'm glad they've done it.
The MPC marginally hiked its GDP forecast for FY24 to 6.5% from 6.4% projected earlier, with the third and fourth quarters expected to register slightly higher growth than expected earlier. Governor Das said that economic activity remained resilient and the higher Rabi production would be a positive for the agriculture sector and rural demand. But The slight upward revision came even as both the World Bank and the Asian Development Bank scaled down their projections. For its part, the MPC listed protracted geopolitical tensions and global financial market volatility as risks to its growth outlook. Das said that the risks were evenly balanced.
I frankly don't really think that we should expect anything very much higher than 5.5%. And this is for the whole year that I'm talking about. At some point during the second half of the year, the election cycle is going to kick in. And election cycles in India have always meant a massive increase in expenditures. So the weakness that we've been seeing in consumer sentiments and consumer demand will be at least partially, if not substantially, offset by the election spends. And so the second half is likely to look a lot better. But the first half, I think, will be weak.
Well, our forecast for FY24 is 6% GDP growth, slightly higher in the first half, which lowers down in the second half. And I think the interesting part is that most of the projections are in the range of 6 to 6.5%. And in this age of uncertainty, couple of basis points here and there do not matter. Actually, it's the range that matters.
The MPC slightly lowered its projection of retail price inflation for FY24. Consumer Price Index-based inflation rate is expected to be 5.2% for FY24, compared to 5.3% expected earlier. The MPC said that the impact of the recent unseasonal rains and hailstorms on food prices would have to be watched. It also said that core inflation would remain elevated due to lagged pass-through of input costs. The MPC based its inflation projections on a normal monsoon and an annual average price of the Indian basket of crude oil at $85 per barrel for FY24.
Our assessment is similar. I mean, we expect inflation to be at 5%, but that is based on a very crucial assumption that monsoons will be normal. But there's a big question mark to that because of El Nino likely to play out. The 5% inflation forecast is for the full year. And I think for the first half of the fiscal year, we expect around 5.2%.
The experts Business Standard spoke to have different opinions on India's FY24 growth rate. There's also the RBI governor's warning that we are living in very volatile times. However, the RBI has decoupled from the likes of the US Fed and ECB, which have continued pressing the lever on the rate front. This should bring cheer to India Inc., which was calling for exactly such a decoupling. Whether or not the pause pays off by way of increased private capex remains to be seen.
During the MPC meeting, the RBI governor also cautioned that milk prices are likely to remain high in the coming summer. Milk prices have risen by 12 to 15% in the last 15 months. Meanwhile, a dairy product was in the news recently for a very different reason. The country's food safety regulator had to withdraw a directive to use the Hindi word dahi on curd packets after protests in the south. This comes amidst discussions on the front of the pack labelling norms as the government wants to regulate processed food products. Tariq Ahmed's report has more.
The humble curd found itself in a strange spot recently. It was at the center of Hindi versus regional language debate, which erupts every now and then. The fresh row erupted when the Food Safety and Standards Authority of India, FSSAI, told food business operators that they can use the Hindi word dahi on printed curd packet labels along with the local nomenclatures in brackets. It enraged people in South Indian states, especially in Tamil Nadu and Karnataka. They alleged that the government was imposing Hindi on them. The backlash forced the food safety regulator to withdraw the notification. While the curd controversy may have been put to rest, the one on labeling of food packets has been raging for a while now. In September last year, FSSAI had issued a draft guideline on the front of package labeling, or FOPL. It was first recommended in 2014 by an expert committee constituted by FSSAI in 2013. And in 2019, the autonomous statutory body had come out with a draft notification of food safety standards, labeling and display regulations. It had mandated color-coded labels on food items. And in February 2022, the FSSAI decided to adopt the Health Star rating system in its draft regulations for front-of-package labeling. It is still at the draft stage. The Health Star rating system gives a product half a star to 5 stars based on salt, sugar, and fat content. This rating system will help consumers in identifying how healthy a food is. The move comes at a time when the country is seeing a sharp jump in lifestyle diseases. Non-communicable diseases like heart diseases, diabetes, and cancer contributed to over 66% of total deaths in 2019. But the pre-packaged food industry has concerns.
In my view, it has got two kinds of impacts on the companies, on the manufacturers. One, it could lead to, if, as we said, consumers read about it a lot. So since they're health conscious and once they come to know about what is the ingredient, and if they don't find it suitable for their health, it can have a negative impact on the sales of the product, right? Or the other way, if the company might be forced to, in order to change the product ingredients, to a certain level, or to make it attractive, or to still keep it healthy for the consumer, the company may have to increase the cost of the product. So in both ways, it's an additional burden on the company.
So will star ratings help?
Our objections to the proposed Food Safety Authority rules, which have been not yet finalized, is that giving star to an unhealthy food product is misleading. Secondly, giving 4 years to the industry without being mandatory is another problem. Thirdly, the definition of unhealthy food as food high in sugar, salt, or fat has already been defined by WHO and Food Safety Authority. So we would like that they follow those norms, which is if the food product is 10% or more in fat and 10% or more in sugar per 100 gram, and sodium is 1 milligram per kilocalorie. For example, if a product has 400 calories and the sodium is more than 400 milligram, it is high. So what we are saying, just mention high in either salt, sugar, or fat, or any one of these on the label itself. It should not be just left with stars, because star is an award. You cannot declare an unhealthy food by giving stars as healthy.
And will the small industries be affected?
Confusion is being created by the food industry by using the small and medium enterprises that these foods, they will be affected. I don't agree with that. It's a misleading confusion, people and policymakers. The pre-packaged foods defined by the food safety authorities are those packets like this, which cannot be, these are the packets like biscuits or, chips or whatever noodle. These are the pre-packaged foods. They are industrially manufactured by mostly the multinational companies.
The front of the packet labeling that mentions the amount of added salt, sugar, and fat will indeed help consumers make informed decisions. It is a step in the right direction.
Meanwhile, market analysts are not impressed with the Reserve Bank of India's surprise rate hike pause. They feel this might be a temporary pause rather than an end to the tightening cycle. In our next report, Nikita Vasisht and Puneet Wadhwa explore what the RBI's move means for markets and what should investors' strategy be.
The RBI's move to keep the policy rates unchanged has surprised many. As most experts were expecting a 25 basis points hike, The RBI governor, however, has emphasized that the pause was not a pivot in its policy. But the market experts are not convinced. They believe the RBI's justification for the move was unconvincing.
The pause is only for this particular meeting. The fight against inflation continues. So he has said that they will take action, further actions to attain their objective of inflation. And inflation is significantly higher than their target. So, I guess there will be more tightening that would happen. The justification offered for a pause is not very convincing though, because usually in the summary, the governor emphasized that the fight against inflation is very much there, and there was a kind of a hawkish sort of sentiment that was kind of offered.
Markets on their part remained volatile during the day, with the benchmark S&P BSE Sensex and Nifty 50 indices eventually settling 0.24% higher each. Analysts remain watchful of the road ahead for equities as inflation is far from the MPC's eventual target of 4%, while global economies are staring at a likely slowdown.
It will all be a function of how earnings will actually pan out. And, earnings have actually moderated in the recent quarters, and we'll see what happens in the fourth quarter. Our view is that the earnings will continue to be fairly modest going forward. The growth is going to be fairly lesser compared to the consensus estimates. There will be downgrades that will happen. As far as the multiple is concerned, I think the Indian markets are on the expensive side. So that is there, but I don't think there can be a sentimental sort of recovery, especially given the drag that has been there over the last few months, especially from a US banking sector dislocations.
UR Bhatt of Alpha Niti Fintech 2 believes markets will stay in a wait-and-watch mode till further clarity emerges.
Market, of course, is reacting to the surprise element because I think there was unanimity in the market that there will be a 25 basis point hike. But that didn't happen and there was a pause. So I think the market is celebrating that. But as you know, generally markets celebrate surprises a bit more, go to some extremes. So I think that's what we're seeing in the market. There's a lot of celebration as far as this particular move is concerned. But we have to see how the statement goes, because finally it is not just about the pause that matters, but whether the market would be interested in knowing whether this is the end of the rate hike cycle or this is just a pause. As you see, the CPI inflation continues to be outside the range that RBI is comfortable with, that is 2% plus minus 2. So therefore, there needs to be some more interest rate hikes generally, if past indications are anything to go by. And if there is an indication that this is only a pause, but inflation is still uncomfortably too high above the range, so therefore they will have to probably revisit this space very soon to see whether further hikes are warranted. And if there is no indication that they are actually contemplating a complete reversal of policy, or at least a pause, an extended pause, I think the market might give up some of its gains.
Thus, despite a surprise move, equity markets remain range-bound for now. Technically, the crucial resistance levels for the Nifty 50 index is 17,600. If it is successful in crossing over this level, a move towards 17,770 cannot be ruled out. Equity markets are shut today on the occasion of Good Friday.
The centre recently told the Lok Sabha that it will constitute the 16th Finance Commission this year. The commission will give its recommendations for 5 years starting April 1, 2026. Now, what is a Finance Commission? Raghav Agarwal explains.
Earlier this week, the Union Finance Ministry told the Lok Sabha that it was going to constitute the 16th Finance Commission in the current calendar year. In the budget 2023, the ministry had allocated 10 crore rupees for establishing attached offices for the 16th Finance Commission. The recommendations of the commission will be for 5 years starting 2026-27. Till March 31st, 2026, the recommendations of the 15th Finance Commission will be considered. The Finance Commission is a constitutionally mandated body set up by the President to give recommendations on the distribution of tax revenues between the Union and the states and amongst the states themselves. It is established once every 5 years under Article 280 of the Indian Constitution. The main target of the Commission is to equalize all public services across the states. Moreover, it ensures a balance between the taxation powers of the centre and the expenditure responsibilities of the states. The Commission consists of a chairman and 4 other members appointed by the President on the advice of the Union Government. The appointment is subject to the existing ruling party's comfort level with an acceptance of those appointed to those key positions. The members hold office for such a period as specified by the President. They are eligible for reappointment. The main purpose of the Commission is to specify how net proceeds of the tax will be distributed between the centre and the states and among the states. It also tells how the distribution of grants in aid will be governed. The Commission also recommends how funds from the Consolidated Fund of India will be used to supplement the incomes of panchayats and the municipalities in the states. Additionally, the Commission also works on the specific topics set aside by the President for them. The first Finance Commission was set up on April 6, 1952 under the chairmanship of K.C. Nyogi. Since then, 15 Finance Commissions have been set up roughly at the interval of 5 years. The previous Finance Commission, or the 15th Finance Commission, was headed by Nand Kishore Singh. The members of the commission were Shaktikanta Das, Anup Singh, Ashok Lahiri, Ramesh Chand and Arvind Mehta. It was set up in November 2017 with a mandate to submit its recommendations in 2 years for 5 years on March 31st, 2025. However, due to the COVID pandemic, a standalone report was submitted for 2020-21. Later, another report was submitted with recommendations for a period of 5 years ending March 31st, 2026. The 15th Finance Commission recommended that the share of states in the central taxes be 41%. This was 1% lower than 42% recommended in the 14th Finance Commission. The adjustment of 1% was to be provided to the newly formed union territories of Jammu and Kashmir and Ladakh. The 15th Finance Commission recommended devolution of taxes to states on the basis of their population in Census 2011. Earlier, it was based on the 1971 census. Several states in South India like Tamil Nadu, Kerala and Karnataka objected to this, stating that they have worked on population control and they might end up losing out on benefits. The 16th Finance Commission will be set up in 2023 itself. It is expected to submit its recommendations by October 2025. The recommendations will then be accounted for in the budget presented in February 2026.
I will achieve, I will fly high. RBI,
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Meanwhile, a report by the Standing Committee on Rural Development and Panchayati Raj tabled in the Lok Sabha revealed that only 9 states have constituted the 6th Finance Commission and barely 2 are active. Some states have not even constituted the 4th and the 5th Finance Commissions, and this affects the release of grants to local bodies. That's all for today. For more news and analysis, please log into our website business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.